All right, let's dive into one of the most critical concepts in all of finance, the cost of capital. This single number, believe it or not, is the bedrock of pretty much every smart investment decision. We're going to break down exactly what it is and, more importantly, why it matters so much. It all really boils down to this one massive question. When a huge company is thinking about a new project, like building a factory or launching a brand new product, how on earth do they know if it's going to make money or just be a total disaster? Well, the secret lies in understanding the cost of the money they plan to use. So, first things first, what exactly is this all-important number we keep talking about? Okay, I know that sounds a little textbooky, but the idea behind it is actually super simple. Think about it. Every single dollar a company uses comes from somewhere. It either comes from investors buying shares or from lenders, like a bank giving them a loan. And guess what? Both of those groups expect a return on their money. The cost of capital is simply the combined rate of return the company has to earn just to keep everyone happy. This is probably the best way to think about it. It's a pass-fail test, plain and simple. If your big, shiny new project is expected to earn a 10% return, but your cost of capital is 12%, well, that project is actually destroying the company's value. It fails the test. End of story. So we get what it is, but why is it considered such a big deal? I mean, why is it this ultimate benchmark in finance?
Because it's everything. The cost of capital is the bullseye. It is the absolute minimum target that any new project has to hit. If your return doesn't hit that target, you are not creating value for the people who own the company. Period.
And it's used for two huge things. First, for capital budgeting, which is just a fancy way of saying deciding which big projects to invest in. And second, it helps the company figure out its perfect capital structure, the best possible mix of debt and equity that keeps their funding costs as low as possible. So, if you remember one thing, remember this. The cost of capital is the hurdle rate. Every single new project has to be able to jump over this hurdle. If it can't clear the bar, it gets cut. So how do we actually calculate this thing? Well, we have to look at where a company's money comes from. Let's start with the first big one, equity. This is the money from the company's owners, the shareholders. The logic here is really clear. I mean, think about it from their perspective. Shareholders take a big risk putting their money into a company. They aren't guaranteed anything back. So what kind of return do they demand to make that risk worth it for them? That's what we're trying to figure out. And you'd think this would be super complicated, but it's not. We really only need two main pieces of the puzzle: how much the company is paying out in dividends compared to its stock price, and how quickly everyone thinks those dividends are going to grow. Okay, let's get practical and use the example from our source material. So for this company, the current stock price, which we call P0, is 80 rupees. The dividend they expect to pay next year, or D1, is 640. And the market expects the company to grow, that's G, at a steady 8% a year. So when you pop those numbers into the formula, here's what you get. First, you take the dividend yield. That's the 6.40 dividend divided by the 80 rupee price, which is 8%. Then you add the growth rate, which is also 8%. And boom, the cost of equity is 16%. That's the return shareholders are demanding each year. And that's really the key takeaway for this section. The cost of equity isn't just some abstract number. It's the very real return that the owners of the company expect to see for taking the risk of investing in it. But wait, equity isn't the only way a company gets funded, right? Let's flip the coin over and talk about the other side, debt. So what's the real difference here? Well, equity comes from owners who face the most risk and, because of that, demand the highest return. Debt, on the other hand, comes from lenders, banks, bondholders. They have a legal right to get their money back with interest, so it's much less risky for them. That means the cost of debt is almost always lower than the cost of equity. And here's the kicker. Interest payments are tax deductible, which makes the real cost of debt to the company even cheaper. All right, this is where the magic happens. Since most companies use a mix of debt and equity, we need a way to blend these two different costs into one single powerful number. And that number is called the weighted average cost of capital, or WACC for short. It's called weighted for a simple reason. It takes into account how much of each type of funding the company uses. And honestly, it is one of the most important numbers in all of corporate finance. Let's look at our next example, Sudeep Corp. This chart shows us the weights we need for our calculation. You can see the company's funding is pretty straightforward: 70% from equity, 30% from debt. So here's how we put it all together. You take the cost of equity, which is 10%, and multiply it by its weight, 70%. That gives you 7. Then you do the same for debt. Its after-tax cost is 5.83%, and you multiply that by its 30% weight, which gives us 1.75. Then you just add those two weighted costs together.
And there you have it, 8.75%. That is the weighted average cost of capital for Sudeep Corp. This is their true blended hurdle rate. Any new project they even think about has to promise a return higher than 8.75% to be a good investment.
And that right there is why this number matters so much. When you're talking about making decisions worth millions or even billions of dollars, the WACC is the single most important number guiding you. So let's quickly recap the big ideas. Number 1, the cost of capital is the minimum acceptable return for any project. Number 2, it's a blend of what you owe to your owners, the cost of equity, and what you owe to your lenders, the cost of debt. And finally, that blended number, the WACC, is the ultimate hurdle rate a project has to clear to create real value. Which leaves us with one final thought, really a question for you. We've seen how these huge corporations use a hurdle rate to make massive financial decisions. But how could you use that same basic idea, a minimum acceptable return, to make smarter decisions with your own personal investments? Something to think about. Thanks for joining me.